Hi, good evening. Welcome to today's lecture. This is basically on the company analysis. In our last lecture, we analyzed a macroeconomic analysis. In today's lesson, we will dwell upon in detail the company analysis. In company analysis, the first thing which comes is the financial statement analysis. Now, what is financial statement analysis? See, it represents the financial condition of a firm at any given point. See, why this particular wording comes at any given point is financial statement is always given for a particular period. It can be for a quarter or it can be for a particular date on which it is asked. So, based on that, this analysis, financial statement is given. See, it shows what the firm owns and what the firm owes. It means what are the assets of the firm and what are the liabilities of the firm which the company or the firm has to clear. See, it reflects the equation asset is equal to equity plus liability. See, equity is the shareholders' equity, and liability are all the borrowings and other debt related items which the company has on its balance sheet or the financial statements. So let us analyze the components of a balance sheet. See, before we start this financial statement analysis, I would like to tell that this is only a cursory view of a financial statement analysis of cash flows, balance sheets, and other ratios which we are going to discuss. This will just give you an opportunity to generally go through a balance sheet and how to analyze the contents of the balance sheet. But this lecture will not give how to prepare a balance sheet. We are only trying to analyze the given balance sheet, given cash flow statements. Okay, so we have to consider that before we start with this further lesson. See, a balance sheet basically consists of shareholder funds. So what are shareholder funds? The shareholder funds include share capital. We know that share capital, whatever the equity the company has raised, whether in terms of, there are many types of equity. I will leave a link in the description what are the different types of equity investments are there. There are normal equity shares are there, preferential shares are there. So the different types of equity shares are there. So that is known as share capital. So share capital has got equity capital and preference capital. Then in shareholder funds, there are reserves and surpluses. That is, any plowback which has been made from the earnings are known as reserves and surpluses, which are kept in the as a shareholder funds. See, reserves and surpluses consist of retained earnings, which I just explained, and share premium. See, this is a non-earning item. Share premium is nothing but the value of the share has increased. So that is known as share premium. And next comes the capital reserves. Whatever is the capital reserves which are there, that will also come under reserves and surpluses. Capital reserves can be any amount which has been kept for capex, that is capital expansion, and other assets. And next comes the securities premium reserve. So this is also a type of reserve which is kept in reserves and surpluses. Debenture redemption reserve. See, what is debenture? Debenture is nothing but a bond raised by a firm. This is a loan in term raised by a firm by giving the investor a bond. So this bond will be redeemed after 5 years or after through 2 years or after the 10 years. So in order to ensure that the end of 5 years or the end of 10 years, the debenture base amount is given back to the that is par value, which we call in terms of bonds. You have to give back the par value to the investor. So the company in every earnings keeps certain amount as a debenture redemption reserve, so that at the end of the debenture tenure, they have to give back the par value of the bond / debenture. Next comes revaluation reserves. Certain revaluation is carried out by the firm, and they have to keep that revaluation reserves also. Now coming to non-current assets. So first it is share capital. Now another part of the balance sheet is non-current assets. Non-current assets means the assets which are long term. That is the other meaning of non-current assets. It basically consists of fixed assets. What are fixed assets? Fixed assets are tangible fixed assets like land, building, machinery. These are valued at their net book value after accounting for accumulated depreciation. We know that any item which has been purchased will have to undergo depreciation. The depreciation methods are various methods of depreciations are there. We cannot discuss all those things in detail. The very popular depreciation method is the straight line depreciation. So first of all, in a machinery is taken, its total life is ascertained, and whatever is the cost of the machinery, it is divided into that total number of years which it may live its life. So that is the straight line depreciation which is carried out. Now non-tangible fixed assets includes patents, copyrights, goodwill. These are reflected at its net value less accumulated amortization. Okay, see the another for non-tangible assets we call amortization, whereas for fixed assets we call it depreciation. We depreciate the because machinery get used. When the machinery gets used, its life reduces. When its life reduces, its value also reduces. Similarly for patents and copyrights, as the patents gets older and older. What are patents? If somebody has manufactured something or invented something, he has the patent, he will register with the government that it is his particular product and nobody can copy it. That is known as patents, copyrights, are all these type of non-tangible fixed assets. Goodwill is nothing but a company must have earned a certain amount of customer base. So that is called as the goodwill. So the customer will come back again and again to buy the same product. So that is goodwill. So these are reflected at its net value less accumulated amortization. So amortization is nothing but the value has increased, but that will be deducted and it will be taken only at its net value. Now coming to non-current investments. Now non-current investments are nothing but long-term investment in other companies in the form of equity shares and loan given to subsidiary. So we shall explain this. Long-term investments means the companies may invest in some other company, buy equity shares of some other company, or it may buy bonds, or it may give loan to its subsidiary itself. So these are long-term in nature, hence they are called as long-term investments or non-current investments. They are stated at cost less any diminution in value which is regarded as permanent. So they are always stated as cost, but after stating it at cost, but suppose you have taken a bond at 100 rupees or something like that, if there is any degradation in the value is happen, every year the degradation in the value is reduced from the cost. So and that reduction is a permanent one. Now coming to long-term loans and advances to the subsidiary. This is long-term loans and advances given to the subsidiary is one form of non-current investments. Now coming to long-term provisions. So what can be the long-term provision? Leave accumulation happens for the employees, provident funds of the employees. An employee has to undergo superannuation. So for these, the company has to make provisions and keep the funds separate. For provident funds, if the provident fund has to be taken out by a person after 5 years, he may take a loan from the firm from his provident funds. For all those activities, the company must have funds held with that. So they keep it as long-term provisions like provident fund, superannuation amount, leave encashment, and other amount provisions. Now coming to, we discuss non-current. Non-current means long term. Current liabilities are those liabilities which has to be fulfilled within 1 year. So these commitments need to be paid back within 1 year. Short term borrowings, working capital requirements, trade payables are all current liabilities. Short-term provisions like dividends and for the taxes also comes under liabilities. Why they come under liability? Dividends has to be paid to the investor and taxes has to be paid to the government. Since it is an outgo, so it comes under liability. Now coming to non-current liabilities. Non-current liabilities are those commitments which need not be cleared in next 1 year. That is long term. Just like long term assets and long term liabilities also need not be cleared within 1 year. These can be long term borrowings, loan from financial institutions, or any bonds which has been given, or currency bonds. So I have discussed that any bonds issued by the firm will also come as long term liabilities. Any deferred tax liabilities also come under non-current liabilities. Long-term provisions to be made also come under non-current or long-term liabilities. See, why a deferred tax liability arise? See, it arises due to the temporary difference between taxable income and accounting profit. So this is a little bit complex to be explained now. Whatever is the taxable income, see, accounting is based on the accrual principle, whereas tax is laid on the based on the cash flows. Hence there will be a difference in tax liabilities. Now coming to long term provisions, provident fund, superannuation, leave encashments are all long term funds. Now coming to long term loans and advances. See, this is generally advances to subsidiaries, associate companies, employees, etc. for more than a year. They all come under long term loans and advances. Now coming to current assets. Current assets are any asset which has to be realized or which are realized within a year. It is intended for sale or for the consumption of company within a year. They are all current assets. You can take inventory as a current asset only. Primarily held for the purpose of trading. So that's why they come under current assets. Even cash or cash equivalent can also be considered as a current asset. Now what are the components of current assets? See, any current investment for the purpose of trading. Current investments include shares and mutual fund investment meant to generate income from cash surpluses. So whatever the cash surpluses held, non-current cash surpluses held with the company, they can invest in short term in mutual funds or shares to generate income. Those are called as current investments. As I explained, inventories, trade receivables, short-term loans and advances also come under current assets. Any inventories which are held, any items or trade receivables, anything which is to be received from another firm is known as trade receivables. But the payment has already made. So those are known as trade receivables. So short-term loans and advances given to company employees or given to its subsidiary, they all come under current assets. See, inventories are raw materials, semi-finished and finished products, stores and spares. Whereas inventory cost include cost of inventory, cost of transit, storage and handling cost. They are determined on the basis of weighted average cost. Weighted average cost, you must be aware what is the cost component and how much it will, just say, let us take for example, how much inventory contribute to the total cost, how the cost of transit contribute to the total cost, how storage contribute to the total cost. A weightage is given to each one of them, and then the cost incurred is multiplied by that weightage to arrive at the inventory cost. Now coming to trade receivables. See, trade receivable is generally advance to customers, advance given to dealers. I have already explained this, but we are explaining it once again, so it will be a benefit for you. Trade receivable is also called as sundry debtors or account receivables. So please remember these names. Sundry debtors and trade receivables both means the same. Account receivables and trade receivables both means the same. They are not different. Now coming to sundry debtors are of two types. Okay, sundry debtors can be good and they can be doubtful. So company usually makes provision for doubtful sundry debtors so that they can write off at the end of each financial year. Now, these trade receivable or the current assets are intended for sale or for the consumption of the companies within a year. Now coming to accounting values and principle. See, this is what I explained about in the last slide. See, historical value, see all assets, as per the accounting principle has to be shown at its historical cost less accumulated depreciation, which we understood in the previous slide. Hence they differ from the current economic value. See, we may do the depreciation, but the asset may still be holding the same value as the date of purchase, but as per the accounting principle you have to deduct the depreciation when taking the value of the asset into consideration. I hope you understand this. Exclusion of intangible assets. See, accounting values usually exclude intangible asset which has good economic value due to the difficulty in objectively valuing them. So what are those intangible assets? Intangible assets can be goodwill, intangible assets can be copyrights, patents, but how to value them, how to objectively value them. So since it is very difficult to objectively value the goodwill, objectively value the patents, hence they are excluded from the accounting as per the accounting values and principle. Underestimation of liabilities as a footnote which may be substantial. Sometimes what happens is the accounting auditors try to understate the liabilities just as a footnote, but that liabilities may be quite substantial. Now coming to statement of profit and loss analysis. See, let us go briefly into the detail, not in total detail, just for our understanding of the analysis of the financial statement, cash flow, and all our ratios. So for that, to that extent, we are explaining this statement of profit and loss. So heads of income oblique expenses is the one part of the statement of profit and loss, and subsets of each head of income oblique expenses. Let us go in detail. The first part in profit and loss which you see you can open up any profit and loss statement of any firm from a site called as inscreener.com. You go there and you can type in any company's name, you will get the profit and loss statement. So you can correlate whatever I am saying now, you can correlate with that. So it will be easier for you to understand a typical profit and loss statement. It consists of revenue from operations. See, what is revenue from operations? Please pay attention to this. These are very important. Revenue is accrued from operation. What are those operations? One is sale of products or service. You can sell car or you can sell IT services. So that is why it is called as sale of products or services. Other operating income. There can be many other operating incomes which will be accrued due to as a revenue from the operation. If we take the financial companies like banks, NBFCs, that is non-banking financial corporations, they are all neither produce products nor services, but they give loan. Hence the revenue from operation is calculated based on the net interest income. Whatever the interest earned by the loan given to the customers is the net interest income. That becomes the revenue for the financial sector. Okay. Now, other income. So what can be the other income? Any dividend income, as we have explained, in non-current assets, the company may have invested in some other company's shares, or they may have been invested in some debentures. So those may generate some amount of dividend income, also interest income. So other income will be calculated as dividend income, or from the sale of investments. Any investment, suppose they have invested in a mutual fund, so they redeem those mutual funds, so the sale of that investment will also come as an income in the head of income oblique expenses, because when you sell the investment, when you sell the mutual fund, the money is going to come back to you. So where will you show it? It has to be reflected in other income. I hope you understood till now. Now coming to expenses. See, what are the expenses incurred? Okay, now the expenses can be due to material expenses. Material expenses are what? Cost of goods produced. COGP means cost of goods produced plus SIT minus inventories of finished goods. Okay. Now, employee benefit expenses, whatever is the employee salaries and all, will also come under employee benefit expenses. Employee benefit expenses includes your salaries, wages, employee provident fund, ESOP, and welfare expenses. ESOP is employee stock option. Next comes finance cost. What are finance cost? If you have taken a loan, you have to pay interest, right? That will be shown as interest expenses. So the finance cost can be the interest you pay for the loans you have taken, the dividends you pay for the equity shares you have raised, or any foreign exchange gain oblique loss will also come under finance cost and borrowing cost. Next comes depreciation and amortization is also reduced from the operating revenues. Hence, they will see this is a non-cost expenditure. It means this is a non-cash expenditure. Depreciation and amortization is showed as an expense based on the method of depreciation and amortization used, but they actually does not, in hand, no money is taken out. It is just a depreciation and amortization of assets. And there will be number of other expenses included in the while you are managing a company, that will come under other expenses. Now come exceptional items. So this is very important, because when you look at the balance sheet, you may look at a very fat profit after tax, but in that you will see very less revenue from operations, whereas exceptional item may be very high. Exceptional item, how does it come? It come because of sale of assets. Okay. So like these exceptional items are infrequent. It means it is not very frequent. Whereas, but it is not unusual also. Usually you have exceptional items once in a while in any of the company's profit and loss statement. See, exceptional items has to be shown separately because of its size. Whenever this event of exceptional items happens, the amount which is generated will be very, very substantial. Hence, it has to be shown separately. Example include sale of fixed asset, I have explained. And some of the inventories must have gone wrong. So you can write off those inventories. Those inventories may have become obsolete. Abnormal charges for bad debts. Suppose some of the trade receivables did not materialize and they become bad debts. You have to charge off those bad debts. They all come under exceptional items. So we understood the revenue from operation and other income. What are the other income other than the core operations of the company? And then you see what are the expenses which can happen, and then what are the exceptional items or events which can happen. Now coming to extraordinary items. See, there are two things. One is exceptional items and then another is extraordinary items. See, again, it is not unusual, but it is not infrequent also. Suppose sale of company's oblique subsidiary comes under extraordinary item. Suppose if a company had a subsidiary and that company sell this entire stake of that subsidiary, then it will come as an extraordinary item. Sale of investment in subsidiary. Suppose a company has invested in its subsidiary, but it will sell all the shares of that particular company, then it will be considered as a extraordinary item. Diminution in the sale of fixed assets. So any sale of fixed assets generate money. Hence they come under extraordinary items because they are not part of operating revenue. So we have to be very careful while assessing a company. Company may generate income by many means. That's what we are trying to explain. But the core income is the operating income. That is the core function of the company. Suppose you are manufacturing cars, the core operation is manufacturing of cars. So you should focus on the revenue generated by manufacturing of cars rather than the dividend received by the company by investing in other companies. I hope the things are clear now. Now coming to basic earnings per share. So see, this will be a very important concept, earnings per share, because we will be deducing many ratios from this earnings and earnings per share. So please pay attention to this. See, as per the accounting standard 20, basics earning per share and diluted EPS should be presented for each class of shares. What are the class of shares? We have already discussed: common equity shares and preference shares. See, it is net profit oblique loss for the period, whatever the profit or loss incurred, divided by the weighted average number of shares outstanding. Whatever is the shares outstanding is the weighted average of the number of shares outstanding, because there are different varieties of shares, as we have explained: preference shares, common shares. So weighted average is taken. However, the dilution in shares due to conversion of debt to equity, warrants and stock options should be considered. So let me explain this concept. See, first of all, earnings per share is nothing but whatever the net profit you get, divide by the number of shares you are holding. Okay, why they are saying, see, don't get confused with weighted average and all those heavy words. Weighted average is nothing but, suppose there are two types of shares generated. One is the common share and another is the preference share. What is the weightage? If there are 70% of common share and 30% of preference shares, then the weightage for common share becomes 70% and weightage for preference share becomes 30%. And then the number of shares held as a common share and the number of shares held as a preference share is then multiplied by 0.7 and 0.3, and whatever is the value you get is the weighted average number of shares outstanding. I hope you understand that. Now coming to the dilution in shares, what happens sometimes, the company must have issued a convertible debt. Convertible debt means you can consider convertible debt as the one debenture issued, but the company gives them permission to convert that debt into equity. So if that dilution happens, then we have to include that shares also into this. Number of shares outstanding should consider this debt converted to equity. I hope you understood what I am saying. Now coming to diluted earnings per share, when we consider debenture, see, that's what I'm saying. Debenture is nothing but, don't get confused by debenture. Debenture is nothing but a bond. Now, first one is existing equity shares you are holding. And how do you calculate it? Find the amount of equivalent equity shares corresponding to debenture outstanding. So whatever is the debenture outstanding, so you find out the equivalent number of shares, because suppose a company has issued debenture, they may have said for every debenture they may give half a share, or sometimes 1 share, or sometimes 2 shares, or 5 shares. So for each debenture held by a particular investor, suppose if the company says they are going to convert it into 2 shares, then you will consider for every debenture there will be 2 shares has to be taken into consideration. See, that is what they are saying. Find the amount of equivalent equity shares. Suppose if a company is converting 100 debentures, and they have said that for every debenture they will give convert it into 2 equity shares, common equity shares, then you have to consider 200 equity shares. So add 1 existing equity shares, number 1 point, and the equity shares of the debt debenture converted to equity, you add up. So this is the number of shares outstanding. Calculate after tax debenture interest. See, debenture must have earned some interest also during that particular period when the conversion happened. So you have to calculate after tax debenture interest which has been expended. So number of debentures into coupon rate, whatever the coupon rate which was decided, into 1 minus interest rate should be considered. 1 minus interest rate is nothing but the interest which you have paid will be deducted from your coupon rate amount. Suppose if you have got a debenture valuing 100 rupees, the coupon rate is 5%, so you earn 5 rupees. Suppose the interest rate is 30%, so 5 rupees ka 30% is 1 rupee 50 paise. So 5 minus 1 rupee 50 paise will become 3.5. So you will consider 3.5. So this is the after tax debenture interest. Now adjusted profit after tax now is equal to net profit plus after tax debenture interest. Whatever we calculated at serial number 4 will be added back to net profit, and then the same formula which we have used here, net profit divided by the weighted average number of share outstanding will be considered. I hope you have understood it. Please see this video again and again, you will understand what I have said. Now coming to diluted earnings per share when we consider stock options. Let us see what are stock options. See, you are having existing equity shares that will always be considered for earnings per share, and you find the number of equity shares corresponding to the stock option. Okay, whatever the stock option given to the employee stock option, so that you have to consider. Find the difference between the fair value of the equity less the exercise price decided at the time of issue of stock option. See, I will explain it. See, whenever a company issues stock options to its employee, a particular exercise price is decided. Okay, so once you decide that exercise price, then you find the difference between the fair value. What is the value of the stock on the day in which you are considering a EPS calculation is going to be done? On that day, what is the fair value of the company's share? So the difference between the fair value and the exercise price will be considered. Suppose if 1300 stock options are raised at an exchange value of 20 and fair market value is 30, then equity share considered to be added to this number 1, serial number 1, to existing equity share is 1300 is the stock option into 20 is the exercise price at the time of issuing option, and current market price is 30. You divide 20 by 30. So you are going to basically invest, add 2000 shares to this equity shares. Then diluted EPS is again the same formula, net profit divided by adjusted equity shares. Please, whatever I have explained, listen to it again and again. It is very simple, and you will understand what is diluted earning per share when we consider stock option, and what is the diluted earning per share when we consider debenture conversion. Okay. Now let us understand what is economic income. See, always economic income always measures in terms of whatever cash received. For example, at the start of the year, if you buy a share at 30 and it gives a dividend of 2, and at the end of the year its value is 40, so your economic value will be, the market value is 40 plus you have received a dividend of 2, so it becomes 42. Whereas in case of accounting income, it varies because of the following reason. Accrual principle, as I have explained to you, in an accrual principle, cash will not be considered. Okay, in this concept, transactions are recorded as and when they occur, irrespective of the day of receipt of cash. If at any particular day any transaction has occurred, sale of goods or purchase of raw materials, whether you have the amount have been paid or not, or the amount have been received or not, you will record the total amount which has been paid for raw material which is required to be paid, or the total inventories which has been sold, even though the cash has not been received, will be considered. So that is known as accrual principle. Next, coming to depreciation, we have discussed this there, in the previous slides. Generally, in accounting method, the depreciation method uses straight line method, as I have explained to you. That is the amount of purchase which is divided by the estimated life of the equipment and is deducted year after year from the purchase price. However, in real life, that is not going to happen. Now coming to another very important concept of accrual income is R&D and advertisement expenses. See, R&D may contribute a lot to the company's profits. However, whatever income expenditure which occurs on the research and development and the advertisement also, see, advertisement increase brand value, whereas R&D increases the quality of the product which has been produced. But they are considered as capital expenditure and they are deducted in the profit and loss account every year. They are written off as expense. So R&D expenses and advertisement expenses are written off as an expense rather than considering it as an asset, because it will increase the brand value. R&D may increase the quality of the product, but those aspects are never considered in the accounting income. That is why there is a difference between an economic income and an accounting income. Now coming to the third important aspect of accounting income, see, inflation increases the value of assets. However, in accounting principle, assets are considered at the historical cost rather than the replacement cost. See, we have to consider the asset as on date. If the same equipment is required to be replaced, what will be the cost of that particular equipment? That should be considered as the cost of the asset, but that is not done. What it is done is, what if the asset has been purchased 20 years back, whatever is the cost of asset 20 years back will only be considered in the profit and loss account and balance sheet. Okay. Now coming to the cash flow statement, it's a very, very important concept. We will go slowly into this concept. Okay. See, a cash flow statement has two parts. One is generation of cash and another is spending of cash. So we have to keep in mind that there are two concepts. One is cash generation and another is spending of cash. See, what are the various reasons you can generate cash? The one is raising of equity. See, when you say that I am going to establish a company, I require money and I am going to give you 1 lakh equity shares valuing 10 rupee today. So everybody will give 10 rupees for 1 lakh, you will get 10 lakh rupees in your kitty. So if you raise the equity, you generate cash. If you issue bonds and say, please give me 100 rupees and I will give you 5% interest, so every person will give you 100 rupees. So you will again be getting 100 rupees. So by issuing of the bonds also, you can generate cash. Now raise the bank loan, very clear. If disposing an asset, suppose you are already holding an asset, let's just say you are holding a real estate and you will dispose that real estate asset in order to establish a company, still you generate cash. If you sell a product, generally it is an operating income, you generate cash. But how do you spend the cash? Now, if you redeem securities oblique equity, so a person who has taken shares from you during the initial public offer, after 1 year, if he wants to sell it, then who will have to give the money to him? It is the company who has to redeem that securities oblique equity. So that will be considered as an expenditure. See, if you have raised bonds or taken a bank loan, you have to pay interest. That is also spending of cash. Whatever the dividends you pay when you earn profit to your equity shareholders and preference shareholders, that will also come under spending of cash. Now coming to purchase of raw materials, very simple, I will not explain, and acquiring an asset. Now let us consider the components of a cash flow. See, cash flow consists of cash flow from operation. Cash flow from operation consists of cash inflow from operation. Inflow means money will come to you. How does it come from operation? If you sell goods and services, you will get income. So the inflow of cash is due to the sale of goods and services that will be considered in operation. Cash flow from operation. Any goods and services sold will come under cash flow from operation. Less cash outflow from operation. See, when there is a cash inflow from operation, there is a cash outflow from operation also. What are those cash outflow? You have to pay for the suppliers of raw materials. You have to pay employee salaries. You have to pay tax, and there are so many other such components which is related directly to the manufacturing of a particular item, or for the the development of a particular service like software or anything, you have to spend money. So that is known as cash outflow from operation. So whatever is the cash flow generated, positive cash flow generated because of a cash inflow and outflow will be will consider as cash flow from operations. See, we have to be very clear is cash flow from operation can be negative also. Certain companies which are in the initial stages will have negative cash flow from operations. Okay. Now coming to cash flow from investing. Investing, you understand, investing means you put money somewhere else. See, what are the basis on which you get cash inflow from investing? Inflow is through receiving of dividend. If you sell any asset, whether it is a fixed asset or a financial asset, and if you collect loan from bank, they come under cash flow from investing. Less cash outflow from investing. You have taken the money, but at the end of the year you have to pay interest, or if you return the loan amount, or if you purchase any asset, they come from in cash outflow from investment. So if you purchase an asset, you have to shell down money. If you shell down money, that will go as a cash outflow from investing. Now coming to cash flow from financing. See, cash inflow from financing includes loan taken from bank and sale of equity oblique bonds, whereas outflow comes from sale of asset purchase and loan disbursement. Okay. Now, see, sources of cash increases liability also and equity also, because equity is also a sort of liability. So whenever you generate cash, if you take loan will be a liability for you. If you issue bonds, it will be a liability. If you issue equity shares, it will be a liability. So any cash generation will result in increase in liability and equity. And generation of cash is also due to decrease in asset, because if you sell a presently held asset, you generate cash. That's why these two concepts should be very clear to you. See, what are the uses of cash? Cash can decrease the liability. So when you give back your bank loan, it decreases your liability. And if you purchase any new asset, it increases the asset. So use of cash increase the asset. Generation of cash results in decrease of assets. Now let us understand the impact analysis, and it is very important. Please go through it in detail, because cash flow statement is very important for a company analysis. Now coming to shareholder funds. We have already explained in shareholder funds. We just went through those slides. So in shareholder funds, we have a share capital. See, increase in share capital means cash received. So liability will increase and cash generation has happened. The opposite is true. If the share capital decreases, then you pay the cash and liability will decrease. Now coming to reserves and surpluses. Any increase in reserves and surpluses will be a liability. So if it becomes a liability, the cash will be received and cash generation has happened. However, if reserves and surpluses decrease, then you have paid the cash and liability has decreased, but the cash has been utilized. Now coming to non-current liabilities. I am not going to explain all this. We have already discussed this non-current liabilities. So coming to non-current liabilities, long-term borrowing. If long-term borrowing increases, means the cash has been generated and at the same time liability has also increased. Whereas if the long-term borrowing decrease, means cash has been utilized and liability has decreased. Now coming to deferred tax liability. So if the deferred tax liability increase, it means, see, it is already saying it's a liability. So deferred tax means if you have not paid, you are supposed to pay the tax but you have not paid. But it means the cash is held with you, and at the same time the liability has also increased, because at the later stage you have to pay this tax also. And any decrease in deferred tax liability means decrease in liability, but the cash has decreased because you have paid the tax which was required to be paid previously, and that is why the cash has reduced. Now coming to long term provisions. See, long term provisions are made, as I have told you, it will increase cash because that cash is retained with you. But however, it is a liability because at a later stage, some of the employee may, he would like to redeem his, LTC, or he would like to redeem his leave accumulation. So that will be a liability because you have to pay at a later stage. If the long term provisions decrease, it means cash has been paid and your liability has also decreased. Now coming to current liabilities. See, current liabilities is short term borrowing. Short term borrowing increase liability but cash is generated. If the short term borrowing decrease, it means your liability has decreased and at the same time the cash has been paid. It means there is a reduction in your cash. Trade payables means you have to pay. Any raw material has been purchased and that is not been paid, so that was the trade payables. So trade payable is a liability, but since you have not made the payment but you have received the raw material, it has to be that cash has been retained with you. But when you pay that cash, so your liability decreases and your cash component also decrease. Now coming to short term provisions, you make lot of short term provisions which we have explained. So any provisions made is a retention of cash, but retention of cash increases liability, and decrease in liability will result in cash paid or decrease in your cash component. Now coming to assets. Now coming to non-current asset, that is long term assets. Any fixed asset increases means what happens? Your cash reduces. So when the cash reduces, asset has been generated. However, any fixed asset decrease means you have sold the asset. So when you have sold the asset, you receive the cash. Okay. Now coming to non-current investment, that is long-term investment. When you make long-term investment, if there is an increasing long-term investment, cash gets reduced. Okay. At the same time, asset gets generated because you have an investment is always an asset. However, if long-term investments or non-current investment decrease means you have sold some long-term investments and the money received will be considered as a depletion in your asset, because when you sell the non-current investment, that will generate money and at the same time you have to write off the asset. Long-term loans and advances. Any long-term loans and advances given, if it increases, it means the cash component will decrease but the asset will increase, because at some other point of time whatever loan you have given will come back to you, hence it will be considered as an asset. So long-term loans and advances will be considered as an asset. Now coming to money, long-term loans and advances decrease means you have received the money and accordingly the asset has been reduced. Now coming to current assets. See, current assets are current investments. Any current investment you make will result in, if it increases current investment, you use the cash and that use of cash will result in generation of asset. However, if the current investment decreases, because you sell the current investment, you receive the money and at the same time your assets gets reduced. Now coming to inventory. Any increase in inventory will result in use of cash, but at the same time inventories have been received. Inventories are always an asset. Any decrease in inventory results in money received and asset also reduces proportionately. Now coming to trade receivables. Trade receivables are an asset. So trade receivable increase means you have used the cash but at the same time asset has been generated. And if the trade receivable decrease means whoever who has taken finished product from you have returned their money back to you, and hence the asset has been reduced, because trade receivable accordingly gets reduced in your balance sheet. Now coming to cash and cash equivalents. Any cash held is money received, that is, any increase in cash and cash equivalent is money received. Any decrease in cash and cash equivalents are cash used, straightforward. Now coming to short term loans and advances. Any short term loans and advances given will be if it increases, it is money used, and any decrease in short term loans and advance is money received. So these are the important aspects of every entry in the cash flow statement. So please you see this video again and again to understand how each component of the cash flow statement affects increase or decrease in liability, or increase or decrease in assets. Now with this we will come to the end of the video for this session. How a typical cash flow statement can be made with the help of balance sheet and profit and loss account, with various components of operating activities, investing activity, and financial activities, and various financial ratios we will discuss in the next video. Thank you very much.